And joining us this evening is Jeremy Batstone-Carr, who's director at Charles Stanley in London. Thanks so much for speaking with us, Jeremy. The IMF has slashed global growth forecasts once again within a span of what, just 3 months? And, you know, the IMF's also said that how long the slowdown persists will depend really on how fast the US and European policymakers address underlying economic challenges. Should we then expect that we're a long way off from recovery?
I think that we do have to fear that a recovery is a long way off. The IMF's annual outlook is really quite disappointing and may very well be rather over-egging the pudding. In actual fact, the eventual outturn for activity could be significantly below even the IMF's forecasts now, which themselves, of course, have been cut. What's important about this is that the IMF is to some extent supporting what Mario Draghi at the ECB and Ben Bernanke at the Federal Reserve have said, and that is, in the context of Western economies, monetary policy can only go so far. It is up to the politicians to try and encourage growth, but at the same time ensure that deficits don't spiral out of control, and managing the two is fiendishly difficult, not to say impossible.
Also, Jeremy, despite all the austerity measures that Spain is taking, the IMF believes that the country will miss its deficit forecast for this year and even the next. Is there any way out for Spain at all?
I think the problem that Spain's got is that whilst there is a lot of pressure on Mariano Rajoy to accept the bailout and open Spain's books to public scrutiny from the Troika, from the IMF, etc. The fact of the matter is that the more likely the markets believe Spain's formal request for a bailout to be, the lower Spanish bond yields fall and the less pressure on Spain to adopt or take part in a bailout immediately. So in many respects, the markets almost have to engineer a crisis in Spain in order to force the country to the table. That being said, economic conditions in Spain are extremely parlous. The country has not cut spending sufficiently and is not generating enough in tax revenues. We have austerity, we have a fledgling reform programme, but obviously these things don't happen overnight, and therefore the expectation is that conditions in Spain are going to get worse before they get better.
Jeremy, given all the volatility that we're seeing in global equities, would you be advising clients to stay away from the asset class for the time being at least?
Well, I think that we take issue with the assertion that there is volatility in the equity market. In actual fact, stocks have basically been rising throughout the second half of 2012 on comparatively low volumes, admittedly, but also on very little volatility. Now, that's not to say that volatility won't increase, but as far as asset allocation is concerned, our expectation is that equities will remain the asset class of choice for long-term strategic investors, despite the fact that regulators and actuaries are encouraging investors to switch from equities to bonds. We still think, particularly for income-orientated investors, that equities are the way forward. And of course, if we do come to an Armageddon-type moment, then it will be the bond market that is scorched to a crisp, and it will be the equity market that survives relatively unscathed, but not, of course, unscathed in absolute terms.
Right, so Jeremy, then how about the commodities class? Do you see prices gaining further on account of monetary easing in the US and Europe, or do you believe the global slowdown fears are going to keep prices in check?
I think the question about commodities is really very interesting because commodities are very much in the spotlight at the moment. Will they benefit from additional monetary easing from the European Central Bank and particularly the Federal Reserve? Many commodities, of course, priced in dollars. If the Federal Reserve's policy is sotto voce to undermine the value of the dollar, then, as we've seen before, commodity prices should receive a boost. And yet, given the very weak outlook for global economic growth and particularly Western economic growth, there is a suspicion that the pressure in terms of commodity pricing is rather to the downside. And I guess we're talking here about industrial commodities rather than precious metals. So I sense that there's something of a two-way pull emerging in the commodity complex at the moment, which may very well be sufficient to keep prices by and large where they are. It will be extremely interesting to see which pressure wins out. Will it be the backstopping of risk created by the ECB and the Federal Reserve, or will it be the constant concern over the outlook for growth as a consequence of weak economic activity?